It's my great pleasure to join with you in this consequential occasion to discuss global economic challenges. I will offer my observations on addressing these challenges using finance, in particular finance science, to solve these challenges. I'm going to do so by a series of examples of applying intangible financial contracts to solving very tangible economic problems. Now, a well-functioning financial system is essential for economic growth, development, and stability. And the economic system is improved through financial innovation, and the development of financial innovation is driven by three things: science, of course, technology, and economic need. That's what we need to get the implementation. Now, some will say there's a real sector and there's the financial sector, and they're separated. That's a fiction of out-of-date macro textbooks. The two are inexorably connected. And while finance may be intangible, it absolutely has very tangible impact. And I'm going to start with talking about the period in history where finance science, which had developed between the 1950s, I would say, and the end of the 60s, finally became connected to finance practice, and inexorably so. And this was resulted in the emergence of what we call financial engineering. Financial engineering, whether it's in finance or anything else, is simply the application of science to solving real-world problems. So if we take ourselves to the period in the 1970s, when there were great crises were created, a series of major economic shocks and financial events that first hit the United States and then spread throughout the world. And as you can see here on the list, for example, we had the fall of Bretton Woods. Currencies have been fixed around the world for 4 decades. Suddenly they're all fluctuating and no longer connected. Second, we had the big oil crisis. We didn't know we were going to have a second one. And oil prices went from $2.40 a barrel to $14. In the United States, we had double-digit inflation, the highest we've seen since the 1920s. And sadly, so there's a deja vu today. I hope not as much. Double interest rates, highest again in U.S. history. The stock market fell by 50% in real terms in an 18-month period. There was no mortgage money for housing. Why? Because with double-digit government interest rates and a cap on what banks could pay on interest, nobody was putting any deposits in. Now, on top of all this inflation and everything else, we had another problem: high unemployment. You're not supposed to, in economics, to have both high unemployment and high inflation. Treating those when they're both there is a very difficult task. But it happened. We call it stagflation. Let's hope that doesn't happen again. Now, what was the response from all these shocks? Well, unlike in 2008-9 crisis, the great financial crisis where innovation stopped, there was an acceleration and a wave of financial innovation that through the 70s into the 80s, actually continuing to today, but really during the 70s to the 80s, it was just an explosion. And these innovations will later be adapted around the world. I've listed here a few of these that were designed to address all these new risks that have come upon us. Now, I've got so many, I've got 2 pages of 2 slides worth. So this wave of innovations that all took place at this time had the feature that it not only addressed the risks of that crisis, of the moment, but it created a series of permanent improvements to the system that we've been earning the social dividends on for the last 40-odd years, and will continue to do so. So finance, with all these contracts, really did have a great and permanent impact on the economic outcomes. Now, what I'd like to do, I want to take you through a real-world example from the later period in the 1990s of how we can use financial contracts in an engineering way to solve physical important problems and do so with greater efficiency. And by the way, even though this is an example from 30 years ago, it has a 2020 tail to it, as you'll see. So going back to the early 1990s, Germany had reunified and as a policy matter, wanted to bring the East economically up to the West. And in this particular example, Leipzig, the city of Leipzig was in the East. In order to grow, it needed to have more electricity. To get more electricity, it had to get more natural gas to the city. And so it had a choice of how to get the gas. And it had really two alternatives that were offered to physical alternatives. One was to take its gas from the West, the short pipeline from the North Sea. The other was to get its gas from the East, from the Russian grid, with a much longer pipeline. Now, it would seem natural to say, why not take the less expensive pipeline from the West and move on? However, the Russian deal offered not only gas, but it offered a fixed price for gas at so many Deutschmarks, this is before euros, so many Deutschmarks for MCS for 15 years. So they promised a fixed price for the gas for 15 years. The city managers, as well as the head of the CEO of the pipeline company, were actually very attracted by this. And so they were leaning towards doing the Russian deal. A bank, JP Morgan, it happened to be, who had a division that did financial engineering solutions, got wind of this. And the idea was, can we come up with something better for Leipzig than these two alternatives? And certainly better than the Russian one they were leaning to. And the answer they came up with was a very simple one. It simply said, go take the gas from the West, do that physically, and and buy your gas at the spot prices, whatever they are, okay? However, we'll sell you a contract for the next 15 years that anytime you pay more than the X Deutschmark per MCF guarantee of the fixed price of the Russian contract, anytime you pay more than that, we'll make up the difference. So you, Leipzig, end up paying either the price that the Russian deal fixes or less if the market price is less. And by the way, we'll do this for a price, and the price is $125 million to JP Morgan. And as we can show you, that is less expensive, and you can have your cake and eat it too. Now, to show you how a really well-engineered solution using contracts as a replacement for that long physical pipeline, I want to take you very quickly through a comparison of the two alternatives that were there. Here's the Russian contract. We see the Russian contract was $300 million to build the pipeline, with the $50 million for the pipeline, so the short pipeline to the West, plus the 125 to Leipzig, to JP Morgan. Leipzig saves $125 million in capital costs. Then we look at the operating costs. The Russian one was a fixed number of Deutschmarks per MCF, let's say X Deutschmarks per MCF. The JP Morgan one says you either pay the spot price or X, whichever is smaller. So the operating costs are less. But I want to also use this to show how other risks and characteristics that were important in the real world solution that are often not thought about in just looking at simple financial analysis were some of the other risks. So, for example, political risk. What happens if they do the Russian deal and 3 years later, the price of gas is half X? That is to say that they're committed to pay X and the market price is X over 2. How are we going to explain to the citizenry of Leipzig why the city is paying twice the price that people can buy in the market? It's a very complex story. It's politically very difficult to meet. The JP Morgan solution, on the other hand, eliminates that risk because you never pay more than the spot price. And so you don't have regret of having gone into a fixed price contract. Second one is, yes, the Russian contract guaranteed 15 years of fixed price in Deutschmarks. But as we though at that time, and is still true to this day, that Russia has not always fulfilled the contracts it's promised to do. And in particular, in this case, 6 years after these contracts were done, Russia defaulted on debt that it issued only 6 months earlier, and the debt was in rubles. It could have printed the money. So there was contract performance risk. In contrast, the engineered solution from JP Morgan, the commitment to pay anything over the specified price, was a full faith and credit commitment of JP Morgan, a AAA global bank. So it eliminated contract risk. And finally, what next we want to consider is geopolitical security risk. If you did the Russian deal, Russia would control the flow of gas to Leipzig. Sad to say, but that's, as we see, an issue today. And finally, and this is very 2022, is the environmental risk. If they had built that Russian pipeline, done that deal, they would have built a very long, dirty pipeline to connect to the grid. Instead, the solution they did end up physically doing was the shorter one to the west. And so there's actually a greener solution. It did not build an extra long, dirty pipeline. So summary from this example is that if you do a really well-engineered solution, simply using intangible contracts, JP Morgan was able to provide a solution that was both more efficient, cost efficient, and greener. Now, these contractual agreements, option prices and so forth, are a central part. They're one of the cornerstones of the modern global financial system. And I just put these numbers up to show you that from the time when the first option markets were created back in the 70s, now today you can see the growth of contracts. That's 10 billion contracts traded last year. Contracts, that's trillions of dollars just in listed options. But now if you go to the full derivatives market over the counter, which includes swaps on everything from gold and currencies and interest rates in particular and so forth, we're now talking about a notional amount. That's the total amount being covered by these contracts, transferring risk and so forth, is of the order now of 600, or it has times been even as high as $700 trillion. To frame that for you, I plot on this graph. This red line is the entire global GDP, around 100 trillion. So you can see these are enormous financial markets, enormous contractual markets. And what I want you to see is that these are there, they're part of it, and they are a fundamental part of our solutions that we are going to produce for real economic activities, okay? I wanted to show you this graph of financial innovation, which is the way we improve the financial system since the 12th century. This is showing you the timeline of major innovations. And what you can see instantly from this graph is how not only we've had innovation for centuries in finance, but the rate of innovation is accelerating dramatically. So in the past, something that might take 2 to 5 or 7 years to innovate may only take 6 months to 2 years to innovate. So the message here is that best practice is not good enough in terms of thinking about innovation of solving problems going forward. That if it's best practice, it exists. If it exists, it's a legacy. Now, if the past is the same as the future, using a legacy to design will work fine. But as you can see from this picture, the future is not at all like the past. And so the important thing to think about when solving problems and using finance as part of that solution is to always not ask the question, is this being done? But rather to ask the question, could this be done? And that's the way we've been solving problems for a long time. Now, in my last few remarks, I'd like to talk about the future, or really the present into the future, of something that I've been working on, which is trying to address the global challenge of funding retirement. And that's important both to financial and social stability, as well as making it so people could have a good retirement. And the reality, everywhere in the world, in Korea, in the United States, but everywhere, you have that individuals are now being more and more to take on the responsibility of funding their own retirement than they've had in the past. So NPS will, of course, always be there, but we can't expect NPS or Social Security in the United States to be the sole source of funding retirement. But we're going to be expected to take on more decision roles in what we call defined contribution plans. And that's where they're all going. That means people will have to make decisions they've never had to make in the past, don't know how to make in the present, and even with education, won't be able to do on their own in the future. So we're going to have to do important innovations to solve and address this problem. And I remind you, this problem is not a bad thing. It's a result, among other things, that everybody's living longer, and we have to adjust to that. So let me just point out one way that contractual agreements can help solve this problem. If you want to improve, to have a good retirement, that is to say, to be able to sustain roughly the standard of living that you've enjoyed the latter part of your work life for the rest of your life. There are only really 4 ways to improve that. And I'm not going to go through all of them. The first 3, save more, work longer, and take more investment risk, are all designed to get more assets so you can have a higher retirement. The 4th one is the one that I want to talk to you about in my closing remarks, which is for whatever amount of assets you have accumulated as an individual, to get the most benefits for the same risk out of it. And the way to do that for working middle-class people, for the vast bulk of the populations, is going to be really from 2 vehicles. One, annuities, and the other is equity extraction from the house. And annuities, I remind you, are simply where you buy a contract that will pay you, like a pension, money every month for the rest of your life. But then when you've gone somewhere better and no longer need money, you give up that money. So let me just show you the impact of contracts that are potentially feasible with an example from using US numbers. Here I've done this for 50th percentile income level in the United States. So prototypically, someone who has Social Security, like the NPS, has a income, has been living on 50,000, a retirement income, because they don't have to save or do other things anymore that would sustain that, is say 36,000 or 72% replacement ratio in any case. And they have some money in a defined contribution plan, personal saving, as well as their NPS, and they have a house. Now, if they just take their Social Security and then live on the bond interest from their personal savings or the defined contribution plan, because they don't know how long they're going to live, in this example, they'll reach 60% of the goal of what they need for a good retirement. If they, instead of holding the bond, they exchange the bond for an annuity, because of the giving up of the money when they don't need it, they can get a higher amount for as long as they do need it. That will increase them from 60 to 70%, 7% of the goal. Nice improvement. But if now you enter into an equity extraction, so-called reverse mortgage, I hate the term. In Korea, you call that, I believe, a home pension. That's a much better name, more descriptive. But whatever the name is, if you were to take out that kind of special equity extraction and use the resources from that to purchase more annuities, then as you can see in this example, you get additional income such that when you add the 3 of them up, you get all the way to 100%. So this is just a fast pass to show you that by using well-designed contracts, unfortunately at the moment, neither the annuities nor the home pension are as efficient and as good as they could be. But we know if we do make them much better, this is the kind of result you can get, which is really moving the needle on addressing the retirement problem. I will say this, on issues such as climate change and other big problems you've been discussing, I don't know what the solutions are, but I can very, very confident that whatever solutions we come up with, finance will play an essential role in implementing those solutions, whether it's financing the outcome, transferring the risk, or providing more sophisticated analysis. Thank you and good night.